what we're going to be going over here is a long-term contract where we're going to have to determine the revenues and the gross profit, and we're going to be using the percentage of completion method here, and it's going to be based on the cost-to-cost basis here. So this is going to be our example here. We're going to have this long-term contract, and we're going to lay it out in this form here, and then everything is reported in thousands of dollars here for simplification, but the contract's going to be over these years here, 20x1, 20x2, and years 20x3. So we have 3 years on this contract. So we start out with our contract price here, and it's going to be for $3,200,000, and I'll just refer to everything here as in this case we'll just use $3,200 here as our contract price. Now the next thing we have to determine is our costs that we spent, or the cost that we've accumulated to date. And let's just say here, looking at year 20x1, we have $800 here on our cost to date, and the estimated cost to complete this contract at this time is $1,200 here. So our total costs here, cost to date plus the estimated cost to complete here, is $2,000. Compare that to our contract price here of $3,200, and our total estimated profit at this point here is $1,200. Now, this is where we have to where we come in with this cost-to-cost basis here. So the percent of the completed to date here, so that's what we have to calculate here, and we're going to calculate that to be 40%. And that's simply taking here, let's just go down and look at that. That's taking the $800 here, a cost to date here, and divide it by the estimated cost to complete here of $2,000. So 800 divided by 2,000 here, that equals 40%. So the percent completed to date here, using this percentage of completion method here, is 40%. So taking the 40% here, the total estimated profit here at $1,200, is total gross profit recognized here would be $480. Now we subtract out the previous year's gross profit. In this case we started here at 20x1, so we don't have any previous years, so it's 0 here. So the gross profit here for the current year is $480. Now we repeat the same steps here for years 20x2 and 20x3. Let's just go through 20x2 here once. So a cost to date here, now we're sitting at $1,650. Estimated cost to complete here is $550. So our total costs would be $2,200. Compare that to the contract price here, $3,200. So we get a total estimated profit here of $1,000. Now we have to determine our percent completed to date here, and that's going to be 75%. So that's simply taking this $1,650 here in our cost to date here, and divide it by the estimated cost to complete here of $2,200. So divide those out here, and you're going to come up with 75%. So again, taking this percentage completed to date here, 75% times the total estimated profit here, $1,000, we get our total gross profit recognized here of $750. Now, gross profit for the current year, we simply take the total gross profit previously recognized here at $480, subtract it here from the total gross profit recognized here of $750. We're going to get our gross profit for the current year here of $270. So that's for 20x2. Same thing here for 20x3. We could go through that here. So in this case, the cost to date was $2,140. Estimated to complete here is 0. We're in this last year here. So total cost $2,140. Compare that to the contract price of $3,200. You're coming up with a total estimated profit here of $1,060. Again, in this case, it's 100%. $2,140 here divided by the estimated cost to complete here, $2,140, 100%. So last year here it would be 100%. So total gross profit recognized, again, just 100% of the $1,060 here. Subtract that from the previous year's gross profit here recognized as $740. 750, excuse me. Subtract those out. You're going to get $310 here for 20x3. So here's, using this procedure here, we determine the gross profit for each of these current years here. 20x1 for 80, 20x2 here at 270, and year 20x3 here of 310. Okay, so now let's go down and let's look at how we would record this here. And what we're going to be looking at here is we're going to be first we're going to be looking at what they call this construction-in-progress account here. It's an inventory account here on the balance sheet here. And then we're also going to be looking at our revenue account here for these long-term contracts. And along with that here, we're going to also have some materials, cash, payables, and so forth, and some construction expenses. But what we want to concentrate on is this construction in progress account here as an inventory account. And what we do with this account here, it accumulates here the costs that we have on this contract plus the gross profit earned on the contract. So that's what this construction in progress inventory account does here. So let's start out with this construction in progress account. So first for our costs here, and this is how this works here. So we're going to be looking at year X1 here. And we're going to start out with our costs here, and this is what you really have to go up and look at here. We have our cost to date here are $800, and we don't have any previous costs, so that would be our cost here for this first year is $800, and then looking at our next year here. And so this is the arithmetic that you have to play. The $800 here for the first year here. Now this next year here at $850. So this is what you have to go back and do here. We take the cost to date here for year 20X2 is $1,650. Subtract the previous year 20X1 cost to date here of $800. So coming down here, that gives us $850. So here's where our construction in progress, our inventory account, we're starting to build that up here for the cost. Debit or increase that account here by, in this case here for year 20X2 here by $850. Now, just going and looking at our last year, our year 20X3 here. So we've taken, what are we working with here? We have the $2,440 and subtract the $1,650. So let's go up and look at that. So our cost to date here, 20X3, that was that $2,140, subtract $1,650 from it. So for year here, X3, we're going to have debit our construction in progress on our costs here $490. So that's just arithmetic that you have to use here. So that's critical when you're looking at calculating your costs here and you're accumulating in your construction in process account here, this inventory account. Just go through that procedure. Just compare as we went here. You take the current year here, subtract out the previous years, and those are the costs to date here. That gives you your costs here. Now, we can go down here, and the next thing we have to deal with in this construction and process account is this gross profit, the gross profit earned. Now, we're really going to be looking at two ways of calculating that so you understand what's going on here. But that would be easy enough. We just take that off our chart here. For first year 20X1 we had 480, the next year here 20X2 270, and then the last year here 20X3 we had 310. So there's where you increase your construction in progress account here, this inventory account, and that's just the gross profit. And we separated out here the gross profit earned for each of those 3 years here, and then we had our costs for each of those 3 years here, and we increased or debit or increase our construction and process account by those amount. Again, for our gross profit here for each of those years, and then we had the costs that we had for each of those years. Okay, so next let's go and let's actually calculate the revenue here. Now remember, the construction and process, that's on our balance sheet here, but this revenue, that's what we're going to realize on this contract on our income statement for this long-term contract. Okay, so let's look at this here, and then we're going to come back to calculating that gross profit here. So for our revenue account here, all we do is we take the contract price. Let's go up and look at that. That was $3,200,000, or I'm referring to it here as $3,200. So up here, you can see that here back on our calculations here that we have laid out on our chart here. Years, it's just constant for each of those years here. That's the contract price here, $3,200. So for the first year here, we would have realized 40% of that $3,200. Remember, we calculated that percent completed to date here, 40% for this first year, 40% here, 3,200. That gives us 1,280 here. And then for year 2 here, well, let's go back and look at that. We calculated 75% here completed to date here. We would subtract out the previous year here, 40%. The difference here is really what we're looking at. The 3,200 times the 75 minus the 40%, what would that be? That's 35%, the difference, times the 3,200. That gives us a credit or increase our revenue here for year 2 here at $1,120. So that's for the first and second year here. And then for the final year here, well, we had the 100% here, and you subtract out the 75% already. included here. So that 100% minus the 75%, what is that? 25% here times 3,200, that's going to give you 800 here. Credit or increase your revenue by 800. That's for year 20x3 here. Okay, so what we want to look at here is this gross profit. Remember, we calculated it above here on our chart here, but let's look at it in these terms. What we're going to look at is our gross profit here is really our revenue minus our expenses. So we take here our revenue for the first year here at 1280, and then remember our expenses here, we calculated those here at 800. So the difference here, 1280 minus 800, that would be $480. So there's our gross profit for year 20x1 that we calculated above here, but we show it here at $480 that we calculated here. So here we're just making the comparison here, revenue versus our expenses here. And then for the next year here, that was at 1120. Our expenses here was 850 over here, so the difference gives us 270. That also matches with our gross profit that we calculated above here at 270. And then for the last year here, we have 800 here on our revenue, and then our expenses were 490, so the difference here is 310. So there's where matches what we calculated above here, 310. Okay, so you can see what's going on here. When we had calculated our revenue here based on the contract price and the percentage completion, but we had to determine it for each of the years here. So just remember, when you're using this, what you're doing is you're making a comparison from period to period here. And we did that for our revenue here based on the percentage of completion, and we also did that on our costs here based on our completion here. So here we dealt with this construction in progress account here as an inventory account, and then our revenue, and then we determine our gross profit, and we calculated that both up above here, how we calculated, and also down here, just comparing our revenue with our costs. And yet moving down to our other accounts here, just so you understand what's going on here. What we would have done here to get these costs here as a debit amount in our construction in process inventory account, we would have credited out a whole bunch of different accounts here. I'm just using it for example. We would have had in here materials, cash, payables, so on here, and those were our costs, and we would have credited that here for each of those years here. That I made the calculations up above here in this construction account here, but we would have credited out here. The first year here was 800 debit here to our construction account here, and we would have credited out 800 here in all these other accounts. I'm just lumping them in together here to see what's going on here of $800. And then the next year here was 850 debit here, credit here of 850, and then that last year was 490 here. Debit to our construction in process account here, and 490 here. Remove it. What we're doing here is just removing all these accounts here and moving up into the construction in process. I worked a little in reverse here, but just to show you how to calculate those costs from year to year here. And then with all these other accounts here, all these materials, all our costs here that we had on our balance sheet here, we would have just moved them into a construction expense account here on the income statement. So for year 20x1, we had those 800 credit here, reduction to all those accounts, and we would have debited. The debit would have gone to a construction expense here of $800, and then the next year 850 goes credit, remove them out of our our cost accounts here into the expense here on the income statement, 850, and then the last year 490 credit here, and move it into a construction account here for $490. So what we've done with this construction expenses account, this was our gross profit. Those were our expenses here, and we're showing them. They've gone to our income statement. Those were expenses here, and just showing them here. That's how we would have done it. So we'd have taken our construction expenses here, income statement, and that reduces our revenue account. Really, that's what we're doing here when we've moved those expenses here into our income statement here. That reduces our revenue. Okay, so that was our gross profit here. Gross profit, the revenue here reduced by those construction expenses gives us the gross profit. But that gross profit, remember, we increased our inventory account here, construction in process account, for that gross profit, and we calculated, showing the gross profit here just based on our revenue minus our expenses here on our income statement. We also calculated that gross profit above. Okay, so that takes care of our accounts here for our construction in process and our revenue, and then our expense accounts here, our costs here, moving them off the balance sheet into our construction and process account here, and also recognize them as expenses here, construction expenses on our income statement. Okay, so the next thing, let's go and thing we have to deal with is our billings and our collections here. So we're going to look at, again, this is in thousands of dollars. We're going to lay it out here for each of those years, 20x1 through 20x3. So our billings to date here, this is what we're going to look at, and we're going to looking at our collections to date and how we are recording. So I've got these numbers here laid out for our billings to date here, and then our collections to date. So start with our billings to date here. That's where we're going to set up this accounts receivable for our billings to date on our balance sheet, and then for any of those accounts receivable, they're going to go into a contra inventory again on our contra inventory account as billings on construction in progress on the balance sheet here again. So let's just look at how we'd calculate that. So our accounts receivable on our billings to date. Well, we start out with the $600 here for the first year here, 20x1. Well, there's nothing in the previous year, so we recognize or increase our accounts receivable here for $600, and then debit that here, and then we would credit our billings and construction and process account here for $600. And remember, that's a contra inventory account. That's why those debits and credits are changed here. And then for the next year, let's just go look at that here for 20x2. We have the 1800 here, and we'd compare and subtract out the 600 for 20x1 that we already recognize here. So we got accounts receivable here for $1,200 here, and then credit billings and construction for $1,200, and then for the last year here, $3,200 minus the $1,800 here, $1,400 here accounts receivable here for the third year here, and then credit or increase our billings and construction account here by $1,400. So all we want to look at here is how we calculated our accounts receivable here from year to year based on the changes here from year to year that we had on our account. Now the next thing for our collections here, and we've got those numbers laid out here. So this is what we collected in cash. So we set up our cash account here in a balance sheet for the collections to date here. That's what we're looking at. That's what we collected to date here. So for the first year, that was $540 here. And then the next year here, well, we have the $1,620 here at 20x2 and subtract out the $540 already realized. So that gives us debit or increase our cash here by $1,080. And then for the last year here, we had the $2,850, subtracting $1,620 already included. So there gives us $1,230. So we increased our cash here for each of those years by those amounts. Simply the difference from year to year that we calculated. And then cash collected, that would reduce our accounts receivable, and I'm just showing them separate here. They should really be in the same account, but just to understand here, we accounts receivable for the collections to date here, that would be in this for cash collections $540, and so on. You just credit or reduce your cash receivables here by the amount of the cash collections. Okay, so you see what's going on here with the billings and collections. First, we have to start with our billings to date here, and you set up the billings to date as accounts receivable, and from year to year you have to figure out increase what your accounts receivable would be. You credit that, and then the you debit that, and then the credit goes to this billings construction in process. That's a contra inventory account, and we'll be looking at that here. So you can see what's going on here. And then as you collect the cash here, those are the collections that we have here. You collect the cash, you reduce your accounts receivable by those amounts. So if I didn't go through that cash collection for this these other years, we had $540 here for the first year here. We went through all those numbers here, and then so we debit or increase our cash, reduce our accounts receivable by that amount here. And then the last year here, let's just look at it, $1,230 here, debit or increase our cash, and then we reduce our accounts receivable here by $1,230. Really, these two accounts should be listed together here, but I just wanted to show you here the difference. Our billings to date here, set up as account receivable, they get recognized in a billings and construction process account. So any increases here in our accounts receivable get increased here in our construction and process as a contra inventory account here. And then when we receive the cash here, any increases in our cash here, of course, reduce our accounts receivable. All right, so next thing we have to deal with, and let's go down here and look at it. We're going to be reporting our construction in process versus the billing and the completion here. So this is the case here where really we should have showed these two accounts side by side here. We have our construction in process for our inventory account here, and that's tied into the billings in process here, a contra. Both of them on the balance sheet, we could put them the contra inventory account that we looked at here. So you can see here, debits here in your construction in process inventory account here would debit plus here is a debit minus here on this contra billings construction account here. So I'm showing, and then credit minus here is a credit plus here, and both billings and construction and process is that contra inventory account, which it works here, reduces the construction and process account. So before we go, let's just look here at the completion before we go on and we talk about what's going on between the periods here. So at the completion here, your billings and construction account here would be closed out, and it should equal your construction in process inventory account. Okay, so our credits here in our billings and construction, all those amounted to $3,200. So whatever we had credited out here, we now debit or reduce or close out this billings in construction account here for $3,200. And then over in our construction and process inventory account, all of our debits here should have added up to $3,200. So we would credit that out here for $3,200. So we removed these off the books here, our construction and process inventory account here, and also our billings in process contra inventory account. Both on our balance sheet here, we would have closed them out here on the completion of the contract. But one thing we want to look at here, and we're not going to get into all the arithmetic here, but during the contract, you compare the construction in process with the construction in process billings account. So you would be comparing that at each of the dates or whenever you're looking at it, at the reporting dates in particular. When we're talking about comparing them here, this is what we want to look at. So if the amount here in their comparison, that is as a debit plus, then it would be reported as a current asset on the balance sheet here, whatever that amount is here on this construction account here. What we're talking about is we're comparing our debits with our credits here, whatever, in this case, the debit here, credit here. So the difference gives us a whatever for the period here. I'm just showing these are all lumped or shown separate here because remember we had our gross profit here and then our costs, but our billings weren't based on the gross profit and cost. They were just separate for each year here. But to get back down here, during the construction contract here, you compare your construction and process account here with your construction and process billings account here, and if the amount is a debit plus, then it's reported as a current asset on the balance sheet, and if the amount is a credit minus here, then it is reported as a current liability. Not getting into the numbers here, but that's how it would be reported here on the balance sheet. So just remember, if it's a debit amount here, it'd be reported as a current asset, this construction contract here, and then this credit minus here, then would be reported as a current liability here, these accounts here, this construction in process and this billings and construction and process account. Okay, so this is rather a lengthy example here, but we went through it here, and we were working on this long-term contract here and determine our revenues and expenses, and also how we'd record here our billings and our collections to date here. And this was based on the percentage of completion method here on a cost-to-cost basis.